Hello, my name is Andres Rapacholi, and alongside with Marcos Cabarcos and Imran Deo, we decided to make our OIDD Term project about the strategic interactions of high-frequency trading, or as we like to call it, the ultimate finance game. For this presentation, Marcos is first going to walk us through the basics of high-frequency trading and analyze it in terms of context of strategic interactions, both from the viewpoint of the players and from the viewpoint of societies. I then will walk us through how math plays such an essential role in the strategies of high-frequency trading and how it can truly make all the difference in strategy selection.
So first, we're going to start with a brief introduction of what high-frequency trading is. So what is high-frequency trading? So a very brief description. Basically, what happens is, say you're a normal investor, not a high-frequency trader, and you want to buy 1,000 shares of Microsoft, and you see on the screen that there are 1,000 shares in the market that you can buy. And the problem is, 1,000 shares are distributed amongst the 13 exchanges. So when you press the button to buy the shares, the signal to buy them doesn't get to all the 13 exchanges at the same time. And that what the high frequency traders do is that they see that you're trying to buy the shares when your signal reaches the first exchange, and then they buy the rest of the shares on the other 12 exchanges faster, and then sell them back to you at a higher price. So they don't make that much profit out of just one trade, but since they do this at such a high volume, it's a very profitable market. So to do high frequency trading, there are many strategies that you can implement. One of them is having the straightest wire, so that your signal can travel faster between one place and the other. The other one is proximity, which means that you can. What high frequency traders do these days is they place their computers inside the exchanges, and they try to put them as close as possible to the matching engine, so that their signal can actually be the first one to get to the market and put the orders whenever they want to. And the third is algorithms, which means that the high frequency trader with a faster or the most efficient program will be better whenever it comes to actually executing a trade. So here you can briefly see a graph of what of what trading actually looks like. In a minute, you can't actually see many differences in the market versus the amount of trades made. But when you look at the graph in milliseconds, you can see that there are many fluctuations between the market and the trades, because that's what happens. That's what high frequency traders take advantage of. So now let's look at the context of strategic interactions. So between the players, the game discovery in this case would be high frequency trading versus normal traders, or also brokers, because normal traders place their orders through brokers. So the strategy discovery for this is, for high frequency traders, proximity, which is what I mentioned earlier, and it's basically there's a huge market between the exchanges that they charge the companies that want to put their computers closer to the matching engine a lot of money to be able to compete for the closer distance to the matching engine. So specifically, if you look at the New York Stock Exchange percentage of the profits, like most of the percentage comes from actually selling this proximity to the companies to have their computers be the closest to the matching engine. And the other strategy would be efficient algorithms, which I also mentioned earlier, which means that the high frequency traders go out of their way and pay big amounts of money to good programmers so that they can have the best program in the industry. So strategy selection and implementation, as I mentioned, they pay the highest amount to be able to be the closest to the matching engine, and they hire the best programmers, but of course all of these comes at a cost. And for normal investors, there's not much they can do because they are at a disadvantage, but they can hope for the creation of a fair exchange, which we'll get into later. Now, the context of strategic interaction between society and high-frequency traders. So the social behavior, this is about the fair exchange. What happens is basically some guys in the RBC actually discovered the way to eliminate the possibility of high-frequency traders to take advantage of the normal investors. And the way they did this was by creating a program that made their signal get to all of the 13 exchanges at the same time. So this way, whenever you press enter to buy any amount of shares of a stock, your signal would get to all the 13 exchanges at the same time, and that way the high-frequency traders couldn't rush and be faster than you to be able to buy shares before you actually go to the other exchanges and then sell them back to you at a higher price. So this was sort of the reaction that society had to this high-frequency trading thing that happened, and at the end of the day, this fair exchange actually exists, and many people trade on it because that way they are not at a disadvantage. So game behavior in the long run, what happened was that most of the trades actually shifted to this fair exchange, and the specific guys who created it actually were, once they opened the exchange, they were very skeptical about if they would have enough volume to be able to survive, because you need volume to be able to make profits. And what happened was that they had the backing of Goldman Sachs, and that way, once Goldman Sachs joined them in the exchange, all the other banks came behind, and they were able to reach the volume enough to make it a profitable exchange. And at the end of the day, this exchange actually trades a lot.
Okay, so now let's talk about the math behind high frequency trading. If you ask me, what is the key to winning in high frequency trading, then I would definitely say it's math. There's three main components of high frequency trading that rely very heavily on math, making it a very essential part of high frequency trading. The first of the components is statistical arbitrage, or StatArb. So StatArb basically relates different values or factors through statistical analysis, which is then used to make strategic decisions in terms of trading. There are many different types of StatArb strategies. The first one is pair trading. Pair trading is the simplest and most common StatArb strategy. Basically, it relates price levels of two different instruments. So basically, what you do is that you grab two different instruments or two securities that have a stable relationship. Then you calculate the expected difference and the expected standard deviation. And then when you see, when the algorithm sees that there's a very big price gap between the two securities, then you buy the cheaper security, and then because you expect the price gap to narrow, and then when it narrows down, then you sell it out and you make a gain. Then there's different types of other startup strategies, but they're basically related or expanding on pairs trading. So we're not gonna get into much details about it. Then we have risk management. As with every trading, in high frequency trading, there's a lot of risk induced. Therefore, risk management is a very big part of a winning strategy in high frequency trading. There are many different types of risks. Say, like, they can involve risk with the trader itself or the trading venue and whatnot. But the most common type of risk is market risk, which is basically the risk associated with the loss of capital due to market conditions or market volatility. So in order to manage market risk in high frequency trading, there are different orders of steps you can take. So the first order step is stop losses. Stop losses basically tells the algorithm to stop trading or to sell securities once the losses exceed a threshold. The second order is volatility cutouts. So many different strategies work in different volatility levels. So some strategies work better with high volatility, and some work better with low volatility. So basically, what volatility cutouts are, there are rules that you implement and say, like, okay, if these rules are met, then I'm gonna execute this strategy. But if these rules are met, then I'm gonna execute this other strategy. Then the third and fourth order steps are value at risk. Value at risk, basically what it does is that it is a probabilistic analysis of potential loss. So this tells you how much you can lose, and this is very important because it gives you an idea of where the market is going and how much you should trade and how much you should get involved. And then hedging is the higher order. It is basically creating a portfolio. So getting all of your securities, implementing all the risk management steps, and creating a portfolio that minimizes risk. So the third mathematical component of high frequency trading is a principal component analysis of high frequency data. So PCA, or principal component analysis, is basically the analysis of variance to reduce dimensionality. So you get your securities and all of your trading information from high frequency data, and then you get the covariance matrix. And the covariance matrix is going to be huge because you have a lot of trades, you have a lot of information. But with PCA, you can reduce it so that you keep the largest eigenvalues or the most important eigenvalues, and then analyze that. So you can analyze a lot of data from less information. So in classical trading, even though you do reduce dimensionality, you still need a lot of information. So to run PCA on classical trading, then you will need years and years of information, and it just takes too long. So in high frequency trading, we get rid of this problem because there are so many different trades each day, each second, each minute that in fact you can use much less information to run principal component analysis effectively. Once you have the covariance matrix and you can see the variation, you can use this to infer statistically where the market is going to go and what steps you should take moving forward. And just without getting into many details, here are the three factors correlated to the principal components of the PCA. And basically what you can do with this is that you can see how much it is varying from the expected return, which is basically correlated to the black line. And then you can see, if the market is growing or if the size is growing, then what should I do? So that's it for today. Thank you. And if you have any questions, feel free to email us at the email address listed in the slide. Thank you.